If you have a bonus, an inheritance, or a large amount saved up and sitting in cash, there's one question you're probably asking. Do I invest it all at once, or do I spread it out over time? Almost every piece of content you will find online claims to answer this question. Very little of it makes the distinction that actually matters, which is that this is not one question. It's two completely different questions, depending on your situation. Now, quick note, this is not financial advice. Do your own research. Scenario A. You have received a windfall, an inheritance, a bonus, a property sale, savings you built up over years. You now have 30,000, 50,000 euros or more sitting in cash. The question is, invest it all immediately or deploy it gradually over months? Scenario B. You earn a salary. Each month, you have a fixed amount you can invest. 300, 500 or 800 euros. You are not choosing between investing now or later. You are investing as the money arrives. These look like the same question. They're not. Scenario A has a clear evidence-based answer. Scenario B is not really a strategic choice at all. It's simply the reality of how most people build wealth. Let's start with scenario A, because this is where the data is most useful. Vanguard conducted a study examining global markets using the MSCI World Index across rolling one-year periods from 1976 to 2022. This research was published in February 2023. They compared two strategies: investing a lump sum immediately versus spreading the same amount over 3 monthly installments, the most common cost averaging approach. The result? Lump sum investing outperformed the 3-month cost averaging approach 68% of the time. That advantage held consistently across every individual market Vanguard tested, not a fluke of one country's data. For an all-equity portfolio, the median outperformance of lump sum investing after 1 year was 2.2%. Not enormous, but consistent, and grounded in nearly 5 decades of market data. The reason lump sum investing wins is not complicated. Markets rise more often than they fall. Over the same 1976 to 2022 period, Vanguard found US stock beats holding cash roughly 3 years out of 4. If markets are more likely to be the better place for your money than cash, then the money you keep in cash while waiting to invest is money that is missing the return. Every day your capital sits outside the market, it is not compounding. The longer you delay deployment, the more compounding days you lose. Lump sum investing puts the maximum amount to work on day 1. The roughly 30% of cases where cost averaging wins are almost always periods of sharp market declines shortly after investment. But you cannot predict those periods in advance. And the base rate, markets going up, means that waiting is statistically costly more often than it is protective. Now, here's the important clarification that most content misses. The Vanguard study compares 2 ways of deploying capital you already have. It does not say that regular monthly investing is an inferior strategy for building wealth. For someone investing 500 euros per month from their salary, there is no lump sum to deploy. The money doesn't exist until it is earned. Monthly investing is the only option available, and it's an excellent one. The performance difference only exists when you have a choice. If you receive an inheritance of 50,000 euros and you spread it out over 3 months, rather than investing it all on day 1, you are making a choice to keep a declining cash balance on the sidelines while it gradually moves into the market. That cash is not compounding. That choice has a measurable expected cost. Monthly investing from salary is not a strategy choice. It's how most people build wealth. Lump sum versus monthly is a question that only applies to windfalls. The reason most people choose gradual deployments even when they have a lump sum is not mathematical. It's psychological. If you invest 50,000 euros today and the market drops 20% next week, you have just watched 10,000 euros disappear on paper. That's painful in a way that is disproportionate to the actual long-term damage. The loss feels much worse than an equivalent gain feels good. A well-documented cognitive bias called loss aversion. Monthly deployments soften this behavior. You are buying at multiple price points. If the market falls after your first tranche, your subsequent purchases are at lower prices. The experience feels less catastrophic. This matters because the best investment strategy is the one you will actually stick with. If investing a lump sum immediately would cause you to panic and sell during the next correction, then gradual deployment, despite its statistical disadvantage, may produce better outcomes for you personally. Know your own psychology. The data favors lump sum. Your behavior is the variable. Here's a practical framework. If you have received a windfall and you have a long time horizon, 10 years or more, the evidence supports investing the full amount as soon as your brokerage account is ready. Not because it always wins, but because it wins more often than not. And the expected cost of waiting is real. If the thought of a 20% drop in the weeks after investing would make you sell, deploy over 3 months rather than 6 or 12. Vanguard's own data shows that the longer you stretch a cost averaging period, the larger lump sum's advantage becomes. A 3-month split keeps the gap between the two strategies smaller than a 6-month split would. If you are building wealth from a salary with no lump sum, continue your regular monthly contributions. You are already doing the right thing. The lump sum debate doesn't apply to you. The data gives a clear answer for windfalls. Invest the full amount as soon as you are ready. Markets rise more often than they fall. Waiting costs you expected return. For regular salary investors, monthly contributions are not a compromise. They are the foundation of how long-term wealth is built. You are not missing anything. 2 different problems, 2 different answers. Both are correct for the situation they describe. Money is a tool. If you don't learn to control your finances will control you.